Hello, good afternoon. In today's lesson, I want to take you through PPE, property, plant, and equipment, under accounting standard IAS 16. When you look at statement of financial position under non-current assets, you will find all manner of non-current assets. And each of the non-current assets is a standalone and has a what? An accounting standard that speaks to it. Example, you have statement of financial position. Under it, you have your non-current assets. Where you will have machines, building, plants, have goodwill, patents, you'll have investments. So these are, or maybe you will also have right of use of assets. These are some of the non-current assets you may find under non-current assets. Now, when you look at these non-current assets, they have category, or they could be categorized. Now, when you look at machines, building, plants, they are physical assets. These ones, they are physical assets, and they fall under what? PPE. They fall under PPE, which is IAS 16. The rest of them also have what? Accounting standard that are used to determine their subsequent what? Values. An asset like goodwill, after it is determined, we use what? IAS 36 to determine whether it is impaired or not. This is patent, and patent falls under intangible asset. And it is accounted using what? IAS 38. This is investment. And investment, it depends on the type of investment, right? You can make an investment in what? In associates, where you acquired an asset, but you are not in full control of that asset, which is under what? Under IAS 28, right? Or you can also have invested in other company where you are what? Where you have full control of those assets. You can also have investment in terms of what? Finances. And also in finances, like maybe you have invested money in what? In another company, right? And it brings in what? Returns. That can also give you what? An accounting standard under what? Under IFRS 9. So investment has other, depends on the type of investment that you've made. And this one, right of use of assets, talks about what? An asset the company has rented out under what? Under leases. Right? So this is under what? Under leases, or lease of an asset. So this is under IFRS 16. So when you look at when you look at non-current assets, all the items you will find there as what? A specific what? Accounting standard that deals with it. Good. Now, let's look at what? Property, plant, and equipment. Today, that is what we'll be talking. And again, let me also emphasize on what? On the investment. Again, under the investment, we have IAS 40. That also there. So that's what I said. It depends on the type of what investment we are talking about here, right? So if you have also investment, so we call it investment what property, right? So if you have property that you've rented it out for revenue, it also falls under IAS 40, which is investment or investment property. Good. So let us go on with what property, plant, and equipment. So today we are talking about property, plant, and equipment. Falls under IAS 16. Now, when we say property, plant, and equipment, what do we mean? What we mean is that when a company acquired an asset, what is the purpose of what? Of the acquisition of these assets, right? So they are what? They are intangible. The what? The company is what? Is having control over. Right? So if a company owns a tangible items, so these tangible items, what are the purpose of what? These tangible items that the company had what? Had acquired. So the asset must be what? It must be in the total control of what? Of the company. So that when they are using these assets, out of it, they'll be generating any economic benefit from usage of what? Of these assets. So if a company acquired an tangible asset such as building, machine, plant, they are holding them for the purpose of what? One, they are held for what? For use in the production, or they used to supply of what? Of goods, or what? Or service to their what? To their customers, or maybe for administrative purposes, right? So this is one reasons why what the company is holding onto what? Onto an asset. And two, they can also hold assets. As they hold this asset for the above purposes, the asset here should what? Should span, right? The asset they are holding on to what? Should span beyond one accounting year. What I mean is that the usage of the assets during the what? To be more than 1 year or one accounting year. Right. So these are features that qualifies an asset to what? To be PP or property, plants, and equipment. Now let us look at what we call initial measurements. When we say initial measurement or initial recognition, what do we mean by that? They are costs attributed to the what? To the asset that the company has acquired. They are what? They are costs attributed to the item was acquired, or to the item of what? Property, plant, and what? And equipment. And they are what? And must be what? Must be recognized and must be recognized as and what? An asset. If and only if the asset is what? Is in control. You understand? By the company. One, if after acquiring the assets and the assets is classified as what PPE, it must have these attributes. One attribute is that it is what we call probable that what future economic benefit will flow. Right. So here, what this means is that the company that has acquired the assets must ensure that the asset that they have acquired is going to generate cash flow to the company. If it is not going to generate any economic benefit to the company, then it ceases to what? To be PPE, right? So that is one attribute. Now, the second one is that the cost of the item can be measured reliably, right? So here, what these two characteristics mean here is that before a company can recognize an asset in their books, they must meet these two criteria. There should be economic benefits, and the benefits should be measured reliably, which means asset acquired should be able to generate cash into the company, and we should be able to place a value on the asset. For example, so if the company acquired plant for production, maybe the cost of the plant is 100,000. What this means is this plant should be useful to the company, where the assets you shall bring in money, right? And also, whilst it can bring in money, how much did we acquire the assets? That's what's called issue what? The cost should be measured reliably. So in here, how much was asset acquired? The asset was acquired at what? At 100,000. So that is what the initial measurement or recognition talks about before the asset can be considered as what? As a PPE, and be recorded in a what? In the statement of what? Financial position of what? Of the company. When the company goes to the market to go to buy an asset, when they go and buy the asset from what? From the market for production or for administrative purpose, how do they record the value of these assets in their books? How do they record these assets in their books? After acquisition, how do they say that? Okay, how do they place a value on the assets? So when the company goes into the market to acquire an asset, before this acquired asset can be valued and recorded in the books, the company must follow these. So here, that's what we call the element of what? Of cost. So the element of cost. One, the price or the purchase price. of the assets. That's one element of what? Of the cost of the asset. The purchase price of the asset accompanied with any or after any discount that the company will get from what? From the acquisition. Right. So that is one element what they will consider. And then two, any direct attributable in bringing the assets to the what? To the location and condition necessary or consequently necessary for it to be capable of operating in a manner intended. So intended by management. So this is one attribute. Here, what they mean is after you acquire the assets, how much did you buy? Right? Good. So the price of the asset and any cost attributable to the after the acquisition of the assets. Possibly maybe after the assets, maybe you imported the assets. So when it got to a port, to the port, you have to pay duty on what? On the asset. It is part of the assets. It is part of the cost of the assets. Again, transportation, transporting from what? From one location to the main site. That's maybe from the port to the main site. The transportation cost is also a direct cost that has what to be added or adjusted or form part of the cost of the asset. Again, the preparation of the site where the asset will sit for operation is also part of what of the cost of what of the assets. And again, the obligation of dismantling the assets in the future. The initial cost of that will be capitalized. Will be capitalized. Right. So these are examples, or these are what you should. So before an asset initially can be recognized in the books of a company after acquisition, these are what you want. These are the costs you should look out for. These are the costs you should look out for. All right. So example, ADE Company Limited acquired an asset from China and below are cost elements of the asset acquired. The company wants to record the cost incurred on the assets in its books. As an accountant, advise how this can be done. Okay, so this is what you have here. This is what you have. So these are the cost elements that the company has after acquisition of what? Of the assets. Okay, so let me add maybe the 10th one, and I'll bring the note here. All right, so this is what you have. So these are the elements of what? Of costs the company incurred in what? In bringing the assets in what? In its current position. So these are what are the elements that the company what? Cost of elements that the company has, and you are asked what? And you are asked what? Give an advice how this what could be recorded in the what? In the books of what? Of the company. Now let's look at the solution. Cost element. purchase price as part of what of the cost to be considered 200,000. So when they acquire the assets, when they acquire the asset, they said they give them discount of 2%. So here, so the discount, you'll come and less what discount given to what to the company for the acquisition. So you have for 2% multiplied by 200,000. What do we have? That gives you 4,000. So less 4,000 from 200,000. What do you have? 4,000. Okay. So when you less it, what do you have? 196,000. So the next item is what? Free charges. So when they are bringing it, they incurred free charges. How much is free charges? You capitalize it. Free charges is 10,000. Then the next item is what? Import duty. Import duty is what? 50,000. That one is 50,000. Okay. Then the next line of item is what? Transportation cost. 5,000. Transportation cost is part of what? Of the cost, direct cost. Which is how much? 5,000. Okay. The next cost is what? Land prepared. So when the asset is brought, it has to what? It has to place in what in the company for the operation. So the place that they prepared for the land for the asset to sit is also a cost. 6,000 is also capitalized. The next item is what? Personnel trained on the asset. So there are some persons who will man the assets. So the cost that the company incurred in training these assets to man these assets is what they are talking about. And these elements does not directly what form part of what of the assets, right? You see, the cost should be directly that affect the asset so that the asset can be brought in what in the position it can what it can be used for its intended purpose. That's what personnel trained to man this asset got to do with what with bringing the assets in its useful what state. So personnel trained is not directly cost incurred in bringing the assets in what in its useful state. So that one is what is out of what of the cost. Now, loss after production. Now, when the asset is brought to use, they will start operation. So when they started the operation and then the plant has started bringing in what goods for what available for sale, they incurred loss on these what goods that they started selling. So this loss has nothing to do with what with bringing the assets in what in the state useful for what for it and then intended usage. So that one too will not form part of what of the asset. Now we also have what obligation to dismantle the what plant for 15 years. Now this asset they have it what you see it's obligated. You see at a point where when an asset is acquired by the company for its intended use on a certain land, the land can be what can be given to what to the company for a number of years. So after those years, the company has to remove the what the asset from the what from the land. So that is the agreement, right? So now once there's an obligation, it means the arrangement is that this asset what could sit on that land for 15 years, after which they have to remove the asset from the land. So here it is obligatory. So how much is it going to cost them to remove the asset from the land? It's what? It's 20,000. And here is the case: the 20,000 they are going to carry it in 15 years. And in accounting, when you have cash flow, a cash flow can be inflow or outflow. So here, when you have such arrangements, the value has to be discounted to the present value. So this 20,000 you've seen in 15 years, they envisage that it will not value as 15 years. So that's why you have to discount it to the present value. Right. So here, and this cost also form part of what of the element of what of the asset. So here, so you say what dismantling cost. Right. So how do we calculate it? You will have what the formula is what 1 plus r to the power of what negative n. Right. Okay. Negative n. Okay. So you will have it this way: 1 plus, they have given you cost of capital. The cost of capital of the company is 10%. So you'll have what 0.1 to the power of what negative number of years is n, which is what 15 years. Right? Then you multiply by what? By the 20,000 that they expect to what to get. So how do we have it? So in 15 years, the cost of 20,000 will be 4,788. Okay. And then the last element is what advisor who facilitated the acquisition of the house. And the cost is what 5,000. And this cost will also be what capitalized. So you can term it as what agent fee. So 5,000. Because in acquisition of certain items or assets, you cannot walk in. You can't just walk in and go and buy the asset. You need what expertise. You need professionals like lawyers, surveyors, chartered accountants, what to help you in what in the acquisition process, finance analysts, and all those things. So all those people what will take money, right? So when you are factoring the cost of what of the asset, that's what you have to factor it in the acquisition of the asset, right? So when you are done, then you add it up. All right, so you will have 276,788. So this is the what cost of what of the asset that you acquired. This is the cost of what of the asset that you acquired. Now let us look at, having known this one, let us look at certain items that are exclusive or excludes under IAS 16 or cost exclude the following cost. Should never be capitalized. So we have one cost of what? Of opening the new facility. So yeah, this cost. So maybe after the asset was placed in its what useful position, then they have to what make a fanfare, or maybe they've gathered, or they are doing some ceremony to what to opening this very asset. The cost that comes with it, don't go and then capitalize it what to the cost of what of that. It's excluded. And two, cost of introducing new what product. Now you have what this very what plan that you are going to use. There's a new product that you wanted to use this asset for, and you say that okay, we acquire this asset and can produce another product B, then the cost that comes with it, let us capital no, it is not, it's not allowed. Okay. Cost of what? Conducting new business in a new location. This one too is what? Is what? Is not allowed. Don't go and then the cost that what? That you are going to bear for what? For conducting what? New business what? In a new location is also what? It's also not what? Allowed. Right? And the fourth one, you also have what? Administrative or administration and what other costs, cost or overhead. All these are what P and L what item. Don't go and capitalize it to what to the cost of a newly acquired asset. And we have what staff training, as already explained that staff training costs what to handle the asset. So these are common words. Cost that comes with what that comes. So you should what you should be very careful when you are what you are adding up the what element cost to determine the value of it. So this is what we call initial cost of what of the asset. So here, as you have it here, you realize that element of cost, right? So you consider all the elements that are directly attributable to what to the asset acquired. Giving an example such as this is the what? This is the total cost of what of the asset as what as solved below. So when you open your what your profit and loss account, so you have what your statement of what financial position as at year ended. You will have your non-current asset where you have the plant. So how much is the value? 276 276 788. This is how asset is what is initially what measured and what and placed in a statement of what financial position. Thank you for this lesson. This is part one, IAS 16. God willing, I will return with what part two of IAS 16.